Welcome to this short video on contestable market theory. We're looking here at the concept of contestability in markets and what the conditions might be for perfectly contestable markets. This is specifically for A2 economics for this 2023 syllabus, but will be useful for anyone studying economics at A level. So what is a contestable market? An entrant has access to all production techniques available to the incumbents, is not prohibited from wooing the incumbents' customers, and entry decisions can be reversed without cost. So just as an example, I'll talk more about this at the end once I've gone through the concept of contestable markets. But the coffee market might be one that we could think about when we think about contestable markets, and I'll explain this image later. So contestable market theory is based on competition being a threat, not the actual competition in the market. And I want you to be aware that any market could potentially become contestable. That could be a perfectly competitive market, which will be contestable. But at the same time, any kind of market like an oligopoly or a monopoly could also become contestable. So in A2 econs at CIE, you need to know three specific things. The first thing is the characteristics of a contestable market. Secondly, the conduct relates to their behavior, and then also an understanding of the efficiencies related. First, the characteristics. There are no barriers to entry or exit the market. That means firms can just come in and leave. There are no sunk costs, which is basically why it's contestable in the first place. Thirdly, the new entrant has no competitive disadvantages by entering the market, and new firms have access to that same technology. This is also a market where the incumbents, the firms already in the market, are vulnerable to hit and run competition. So this goes back to point one, where there's no barriers to entry or exit. So a firm can come in, earn profits, and then exit again without any costs incurred. So if we look at this standard monopoly or monopolistically competitive market, you can see the firm is profit maxing, MC equals MR, price is up here, and the cost here, so leaving this box here is effectively the profit. If the market is contestable, this huge amount of profit available will attract firms. Now, if they can enter, then there's going to be problems for the incumbents. In this example, then, what we're talking about here is the firms are less worried about actual competition. They will have already priced based on competition if there is any. They're more worried about the potential of competition. So this could be any market structure, like I said before, even a monopoly. Supernormal profits there mean there will be potential entrants, and the incumbents will know that there is a risk of new entrants coming into the market and stealing their profits. If it is perfect, there will be no barriers to entry. So this last point is really important. They use limit pricing or entry limit pricing, which means that they will be earning normal profits in a perfectly contestable market. They will choose to operate at an output where their average revenue is equal to their average total costs. This is what that looks like. Perfect limit pricing. The firm is no longer profit maximizing, so it is no longer MC equals MR, but it's actually ATC equals AR. It means that there are no additional or supernormal profits being made, which means that no firm will wish to join this market. The incentive has been removed. Now, this is perfect in the sense that it is doing it in a way that is choosing like a long run equilibrium of normal profit to stave off any entrant. However, it may be that the firm doesn't go all the way to ATC AR. It may actually just move closer and closer to it. As long as it is lowering its profits, it is going to reduce the amount of potential competition that is interested. Competitive markets have actual competition. Contestable markets, it's all about the threat of competition. So, evaluating these contestable markets, we have to think about, are they any good? So they are, in a sense, that they mean lower prices for consumers and greater output. The potential of entrance means firms will lower prices potentially, and if they didn't, other firms will come in, forcing prices to go down. Furthermore, the greater output will also mean maybe more choice and more opportunity for consumers to buy a wider range of goods. Are they efficient? They can be, because what happens is, as they lower their price, they move towards the socially optimum, the supply equals demand, or the MC equals AR output. And often they will go beyond that to the ATC equals AR, as I showed before in the diagram. They could also be more productively efficient as firms become more interested in lowering their costs to enable them to lower prices to stave off the threat of competition. There is going to be an increase in consumer surplus, and in the long run, as we saw from the diagram, there is likely to be normal profits, either by choice or, if the market is contestable, new firms come in causing competition, which will lower prices, and in the long run, any market that can have entrants will obviously move towards normal profits. So some key takeaways. Contestable market theory is about the threat of competition, and that will influence the behavior of the firms in the market already. Any market can be contestable, and contestable markets are subject to hit and run entry as a firm comes in, takes profit, and then exits again when it is no longer profitable. In the long run, a contestable market will behave like perfectly competitive markets and achieve normal profits. Back to the coffee example, the market for coffee, or the industry for coffee. This is an example of a firm who clearly sees the opportunity to hit the street, open their truck up and sell coffee. I took this photo near a park near me, and basically this entrepreneur has literally just got all the things that you need to do to make a good coffee. He's got the skill set, and he's chalked up a board, and his prices are lower than the coffee shops nearby. And this is essentially a market that has had a threat of entrance, and this market has been entered. So the market for coffee, whilst there are big firms like Starbucks and will dominate the market, there is the threat of other firms coming in and stealing their profits. And this is an example of somebody doing that with relatively low cost. They've just used their own van, and they've bought a few important pieces of equipment that also could be used for home coffee use, and are selling coffee on the street. So there you have it. A contestable market, such as coffee, was all about the threat of competition and not about actual competition. And in this image, you can see that the threat came in and has become actual competition. Thank you for watching. I hope you found the video useful. Let me know in the comments if there are any videos like this that would help you moving forward.